Hello, class, and welcome to our 14th lecture series on financial accounting or principles of accounting. And I'm your instructor, Jamal Haider. So today we'll talk about the long-term liabilities. In our previous lecture, we finished the current liabilities, and today we'll talk about the long-term liabilities. So our first learning objective is that we will discuss the accounting for bonds payable, notes payable, and interest expenses. So let's talk about this. Okay, regarding the introduction of the bond, so basically the bond valuation is basically a finance thing. So we are not going into the valuation stuff, but we do want to know that how the bonds values are, recorded in the books. So let's talk about the introduction of the bond. A bond is a debt security or the debts of issuing company. So rather going to the bank and asking for a loan, so company decide that why not we issue debt certificates like shares. Shares is the certificate to participate in the ownership. So those who hold the shares, they are the owners of the company. But those who hold the debt certificates, they are not the owner of the company. They just, receive interest according to the specified date, and that's it. So some cool features regarding the bond certificates. Number one, on the bond, there must be a company name. That bond is written by this company, and there must be a principal amount. For example, you are issuing $1 million loan and you need it to the public. So you circulate it. So you circulate it with normally these are issued with the value of 1,000. So it means you are issuing 1,000 units of bonds or debt security. So one certificate it is written 1,000. So that value which is on the face or which is printed on the face of the debt security or the bond, we call this face value, principal, maturity value. Why? Because after the passage of the time that you issued this debt for 5 years, after 5 years you will receive the amount according to principal. The other name is also called maturity value. And also we call this par value. Right, guys? So what do we mean by maturity date? Is the date when principal or face value is due. You issued the bond on 1st January 2015, and now you need to retire your loan or you need to give back that amount on 1st January 2020. So that is the maturity date after 5 years. Interest rate is given on annual basis, right? So for example, 9%. What does it mean, 9%? Annually. Come on. Where we are. So 9% annually, which means the interest rates are written on the basis of annual, but payments can be monthly, semi-annually, quarterly, or annually, right? So payments differ. So we can calculate that if biannually or semi-annually, it means the interest payments are twice a year. Quarterly means that interest payments are to be paid 4 times a year, or monthly means interest payments are paid every month or 12th in a year, right? So the terms of the bonds, number one, the term secured serial, unsecured. So these are called the types of the bond. The term bonds, that is issued with some kind of terms, you can say that. Okay, bonds is going to be pay you the money, the full money is going to be paid you after 5 years. Okay, the uh, bond is going to be used with specific purpose. For example, we are issuing a loan, issuing a bond, and we want to uh, purchase a plant that costs $1 million. So in that case, there is some kind of terms. Okay, secured means the bond is issued with some kind of security. So, for example, the plant is sorry. So we are issuing a loan and guarantees that this is the head office building is the guarantee. So if we couldn't pay you, so we can sell this building and we can pay you the loan. We call this secured loan. Serial loans, it means serial bonds. It is that you would be paid on monthly basis or on yearly basis the amount of interest plus some kind of principal as well, right? It's not necessarily that you will receive $1 million. The company need to pay $1 million at the end of the expiration of the bond maturity values like that. You are retiring your loan, interest plus principal. And unsecured loans, which are a little bit risky loans. Why? Because there is no security behind that. The companies say that we are expanding our business and we require a loan. We'll pay you 14% interest. In the market, the banks are paying 6%, right? But why we are paying you higher amount of interest? Because we don't have any security. What if our business, expansions just go wrong and we failed in the new segment, so your money completely lost, right? So in that case, there is no security behind the issuance of the bond. Oops. Okay, let's move forward. Now the bond prices. So bond prices are quoted as a percentage of the maturity value. So I'm going to be turning off my video and then taking out the screen and write it down over there. So just wait for a while. Okay, guys, so here we go. The bond prices are quoted as a percentage of maturity value. So assuming 1,000 face value bond, what does it mean? It means the bond, on the bond certificate, the written price or maturity value or the principal is 1,000. Okay, if the bond is quoted at 100, it means right now it can be sold at 100 and there is no premium or discount, or it means it is treated as par, right guys? Sorry, 1,000, because normally the bonds are issued with $1,000 face value. Okay, what do we mean by 101.5? It means that bond is trading above its face value, right? Let me just erase all this mess here. So it means the bond is traded above its face value. It means it is right now sold, can be sold at premium. So premium means, and so what's the value here? It means 1,015. So all you have to do, this 1.5 means, it means, so like they have calculated here. So it means these are selling above its par value or its stated value or its face value or its maturity value. It means it is trading at premium. You see here that the bond right now is quoted into the market as 88.375. What does it mean? It means bond is right now trading or can be sold at less than the par value or face value. So it means it is selling at discount, right? So the normal thing is that you just multiply face value with the quoted price. All you need to do, you just take it as a percentage. So it means this is 101. You should do this like 1.015. Thousand multiply by this is 0.88375. Right, guys? So all you need to do, this means just like a percentage, but when we quote on the basis of 100, but real amount is 1000. So it is just a normal stock exchange terminologies. If it is quoted above 100, it means it is right now selling at premium. If it is quoted less than 100, it means it is quoted as discount. Right, guys? Okay, now, so how we can say that whether this is premium or discount? So remember, I just give you already give you the trick here, that if the price is above the face value, it means it's premium. So we'll talk about that the premium, which means the amount that is above the par value, that would be treated as credit balance. We'll talk about when we talk about the accounting treatment of bonds, premium bonds or discount bonds. We'll talk about it over there. So what about the discount? It means it is trading right now, which means its price is below the par value, right, guys? So it means the discount balance, the amount that is left, let me just cancel this call. Okay, so the price should be below. It means the market price is less than the par value or face value, right? It is discount, and the difference between these two is called discount, and discount is treated as debit balance. So it means at the end of its, we'll talk about these terminologies I think at the end so that it will be more clear for you, but just for the taste, just I'm going to giving you a hint that if it is treated as premium at the maturity, it will go back to its normal, which means par value. So the bond at maturity, whether it is issued at premium or at discount, the value of the bond at the time of maturity would be its face value or its par value or its maturity value. So if right now the price is above the face value, its price